So while everybody has been sitting around trying to avoid companies that will be negatively impacted by tariffs, I ended up doing the opposite and trying to identify companies that would actually benefit from the current tariffs that are put in place. And I ended up taking a position in a small cap Canadian stock that I do believe will benefit significantly. And it ended up reporting a very strong earnings report, and the stock is up 13% on the day. So I'm going to go over the earnings. I'm going to go over what the company does, and I'm going to go over some clear visuals, some clear signals inside of its earnings report throughout the video that kind of highlight that this company is set to actually benefit from tariffs, especially in the situation of US and China and the escalation that likely isn't going to go away anytime soon. It might be mitigated, but I could see that trade standoff kind of impacting that relationship for quite a while, and this company does stand to benefit quite a bit if that situation does stick around. If you want my full in-depth analysis on this company, because it is a bull list stock over at Stocktrades Premium, I will drop a link in the description with a discount we'll be running for today only. You can hop on the platform, see all my research, my portfolio, my returns. You can hop in the Discord. I'm chatting with over 1,000 Canadians as we speak every single day. It's a great platform and comes with a 30-day subscription back guarantee. So if you don't like it, you can simply send me a email and I'll refund you in full. But let's dive right into the stock, which is Cargojet. So first off, quick overview of what Cargojet does. This is a small cap Canadian company that primarily focuses on domestic freight here in Canada. And the crazy thing about it is this is a small cap company, but it holds the lion's share of market share when it comes to domestic freight through air. And one of the primary reasons for this is there is a lot of regulations put in place by the Canadian government that does not allow major companies to operate airline freight here in Canada. In order to be a Canadian domestic airline, you have to be majority owned in Canada. So these companies, let's say DHL, Amazon, Purolator, things like that, they don't operate airlines for freight purposes here in Canada because it is such a mess around to actually get one running. So instead, what Cargojet does is they operate a platform called ACMI. So this stands for Aircraft Crew Maintenance and Insurance. So what Cargojet will do, because those shippers like Amazon, Purolator, DHL, things like that cannot operate the airlines here in Canada, Cargojet will give them the aircraft, they'll give them the crew, they'll maintain the aircraft, and they'll insure the aircraft. And in turn, those companies pay Cargojet money to actually supply that. The one thing that Cargojet is not exposed to on this side of things is the fuel. The actual lessees or the companies who utilize the ACMI, they are on the hook for fuel, which is not the same as, say, a traditional airline company like Air Canada, which is on the hook for those highly volatile fuel costs. So this creates an element where Cargojet has a substantial moat in Canada on domestic freight shipping through the air, despite it being a small cap company. So these regulations and their utilization of ACMI create a very wide moat for a company like Cargojet, because even a company like Amazon, it is highly unlikely that it's ever going to penetrate that Canadian market because of the regulations and just because of the overall costs. It's likely much more attractive to them to pay a company like Cargojet to actually utilize their services. In fact, a company like Amazon actually entered into an agreement with Cargojet back in 2019 to acquire some warrants to potentially acquire up to 9.9% of the company's total voting shares. So this kind of gives you an idea of how these companies do not want to actually physically enter the market. They'd rather utilize it through a company like Cargojet. And a lot of these deals, when we think of companies like Amazon, DHL, Purolator, we're talking TFI International, Canada Post, they're long-term contracts that are very likely to be renewed in the future, and its ACMI element adds a very strong segment of recurring revenue for the company and is very consistent. So earnings, let's dive into the earnings. So they reported record first quarter revenue of $249.9 million. That is an increase of 8.1% compared to around $231 million last year. And we look at adjusted EBITDA, $80.8 million compared to $78.4 million last year. Again, some pretty strong growth there, especially considering the current freight environment. And when we go down to actual earnings, the company earned around $1.62 per share, which is effectively flat from last year. But the one thing I do want to highlight is this came in substantially higher than analyst estimates. In fact, analysts had only predicted that earnings would come in at around $1.07 per share. So one thing you might notice right off the bat with this earnings portion here is free cash flow came in at a negative $45.9 million. And the reason why the stock isn't selling off on this negative cash flow or anything is they did mention this last quarter when they had stated that they have to repair some engines on their current aircrafts, and they're also buying additional aircrafts to satisfy demand from China, direct flights from China to Canada due to the increase in overall demand between the two countries. So this negative free cash flow is likely not something that the market's going to get too hung up about because it was expected. And free cash flows from a company like Cargojet that are very capital intensive are going to be a bit rocky. So it's better to actually look at that free cash flow generation over the long term as capital expenditures are kind of leveled out. So the earnings for the company were very strong. It was a great quarter from them. But the one thing I do want to highlight is actually the domestic revenue activity with this company and how the results came in relatively abnormal to what you would think, and is kind of confirming my thesis in terms of domestic activity ramping up. So if we look to a chart of Cargojet's domestic revenue, this would be their domestic revenue in Canada, their freight shipping, effectively airline freight demand for shipments in Canada. You can see here that we typically get a rise in the December quarter, the fourth quarter. So we can see here back in December 2020, we had 88.9 million in domestic freight revenue, and then it drops down to 72.3 million in the first quarter of 2021. We come to 2021, we're seeing 100.9 million, and then again in March of 22, we drop down to 82.4. We come to 2022, we're at 100, we go down to 84. You can kind of get the pattern here. And this is primarily because there's a big ramp up during the holiday season. Obviously, when people are ordering Christmas gifts, things like that during the holidays, domestic shipping is going to increase. We can look to December of 2024 at 102.8 million. So what would you expect to see in the first quarter of 2025? Probably a drop off. You could see maybe 90 million, 100 million, some sort of dip. However, the company actually reported a 16% increase year over year. So there's a pattern break here, and there's likely a pattern break due to that tariff situation, the kind of trade situation with Canada and the United States, that buy Canadian movement, and also that movement in terms of tariffs from China. So typically you're going to see a lot of goods that come from China to Canada, they will be shipped to the United States first regardless, and then to Canada. So in the event of tariffs, if the tariffs persist with a country like US and China, there is a chance, and there's actually a very high chance, the company is confirming that this is actually happening. There's a larger direct from China to Canada shipment in order to offset those tariffs. And you're seeing this in other countries as well. It is not just China. So if this is the case and this continues to persist, there is a chance that Cargojet could see substantial increases in demand when it comes to domestic freight shipping. This is the element I've been talking about the whole time with this company and how it could actually stand to benefit from tariffs. I dug into Cargojet's results and I could not find another instance where domestic shipping in the first quarter actually came in above the fourth quarter. And the company actually mentioned it on their conference call that this is extremely rare. So again, my main thesis with this company and the reason I purchased it and will continue to purchase it is that ramp up in domestic shipping due to tariff demand. So this is only the first quarter of this happening. The company did say that 16% year over year growth is likely unsustainable. But the thing is, we have no idea how tough the environment will get on a trade war situation. And ultimately, the more goods that are directly shipped to Canada instead of going through the United States first and then to Canada is ultimately a bigger demand for Cargojet and its services. So another reason I was adding the company was primarily valuation. If you look at a stock chart of this company, it's been beat up over the last while. And although the stock chart looks like a disaster on a trailing basis, we do have to think that this company had some ridiculous ridiculous demand pulled in during the COVID-19 pandemic when we were in global lockdowns. Shipping was crazy. E-commerce was crazy because people were buying everything online. I don't really think a past stock chart of Cargojet is going to give investors an idea of how strong the potential could be with this company. And when we look to the actual valuation, we can see that the company is trading at a 7.6% earnings yield at this point in time. I typically view anything over 7%. Obviously, on a surface basis, you do need to dig into why the earnings yield could be that high, but I do believe that anything over 7% is something that kind of gives me a clear signal that there's value there, and also the discounts to historical averages. So this is a company that's trading at 5x EV/EBITDA, which is substantially lower than its historical averages, because it is likely the market is pricing in a slowdown in overall freight, which, don't get me wrong, could potentially happen. We're seeing it with TFI, things like that. However, the slowdown in freight, I do believe, will be more than offset by the potential benefit of tariffs increasing the overall demand. And when we look on a price to earnings basis, the company is trading at only around 13x expected earnings. So overall, I do feel the company is relatively attractive at this point in time. Obviously, I purchased and I'm going to be purchasing more, but obviously there is some end risks here. The company is a small cap. It's prone to volatility. If the entire tariff situation does cease to exist and everything goes back to normal, there is a chance that the demand could fade. And overall, although I do think there would still be growth there overall in terms of a demand perspective, if the trade wars cease, we avoid a recession, and some consumer spending picks back up, there's a situation where there likely wouldn't be as much upside potential if tariffs were to just immediately be resolved, particularly when it comes to the US and China. So that's always an added risk there. The other risk would be that their deals with Amazon are coming up for renewal shortly. I would be absolutely shocked if they did not get signed, but there is always that potential. No matter how small it is, there is always that potential, and Amazon is a meaningful customer for this company. It would have a material impact on the business. And another risk I could see here is that increasing demand for China obviously forces the company to buy more fleet, maintain more aircraft, things like that, and it might need to issue more debt or more equity to do so, because airplanes are not cheap at all, especially large freight airplanes. So this is a capital intensive company that, if they spend all this money in order to satisfy the demand in China and the demand eventually falls, that will likely be a drag on the business. So it is not without risk, but it's definitely a company that I'm going to be continuing to build out a position in over the next year or two here. And I'm definitely going to be looking to accumulate this company over the short to midterm. Would this be a long-term hold for me? Probably not. A company like Cargojet is a bit too cyclical for me to ever just kind of buy, set and forget. However, I do believe there's potential here as a short to midterm play, and I'm definitely looking to build this out into a smaller portion, but still sizable enough in my portfolio that I can take advantage of the potential tailwinds moving forward. So everybody, if you like the video, head down below, like the video, subscribe to the channel. And if you want to get more in-depth research on Cargojet and many other stocks I'm quite bullish on, you can head down below to the description, grab that premium discount. I'm going to run it for 1 day only, and we'll see you next time for more great Canadian content.